All right, we're on the 5. I'll get us started. This is the SARE syndication series last class. I'm glad everyone was able to make it. We are sponsored by Palace HQ. If you're interested in LP and investing passively, they're probably one of the best resources to go to learn about it and find other sponsors to talk to. So this last class, what we're going to talk about is offerings and deal structures and how they work in the real estate space. I'm going to start first with identifying what type of investment structure you're buying into first. There's typically 2 routes. One is syndication or crowdsourcing. Usually this is the GP LP side. You've heard about this before. In this scenario, GPs are usually the only ones liable for operating risk and leasing risk. LPs are protected by as much money as they invested. And then usually this requires 10 or more people in the group to make it worthwhile, because legal fees are anywhere from 10 to 15K because it's a security. The other one that happens often is a partnership or a joint venture. It can exist as an LLC, right? They can also exist as a partnership. But the joint venture, the way it's structured, everyone is basically supposed to be a GP. And if someone is supposed to be passive, they are at risk of securities fraud in this entity as a whole. So what that means is maybe you're flipping property and then you bring on an investor who wants to invest with you, and you say, hey, they're a silent investor. They don't have any voting rights, and I control all of it. But then they're giving me money as an investment. They're not doing anything else with the deal. I do all the work. That is technically a security that you're selling. So whoever is that partner who is passive, they still have to do something within the real estate investing project in order to make them not just a passive investor. Because if they are passive investors, then the SEC might come in and say, hold on, what's going on here? And whoever the passive investor is should actually have due clause to say, like, actually, I should have a voting stake, based on my equity or whatever. Usually, because of that, everyone's on the loan. They should be on the loan. And then the maximum is usually 6, because the SEC is not going to look at this single family home and say, like, why do you have 18 investors working together on a single family home? Not everyone's obviously sharing a role. So some people have to be passive, right? And so fractional is changing that, though. They have a different structure legally to make it feel like investors are voting, and technically they're all active participants as a result. So that's how they got around it. And then legal fees for joint ventures are usually less than 2K to set up, compared to crowdsourcing, syndication raise. So now here comes the other part of it, which is equity/profit splits. Your equity, that is what most people understand, right? When you invest with somebody, this is the base version of how whoever's the GP versus LP gets paid, right? You make $1 million profit. Well, whoever had 30% equity takes 30%, and then whoever has 70% takes 70%. And the idea is that as an LP, when you're investing, even if you invest a whole amount of money for the project, your equity is whatever the LP split is, which in most cases, if in a 30-70 split, for 30 GP, 70 LP, you will only get 70% of the profits, even though you funded the entire project, right? This also means that you own about 70% of the equity, right? So it's a fraction of it for tax purposes. Now, the reason why a lot of people enjoy investing in syndications is they have this thing called preferred return, which means each year you have the first right to the cash. If your preferred return's 8% on a $100,000 investment, you are owed $8,000 a year before the GP or anyone else can take their money out, right? And so it's almost like a simple interest loan. The difference is it doesn't have to be paid every month like you would with a lender, right? The GP might say, like, hey, I'm going to defer this later on. So for example, you have a value add project where you invested 100K, 8K a year back, because your building's generating rent. Whereas with a new development, you don't have any income for 2 years. So your preferred return, all that's paid out and accrued and then sold at the end of the project. And so when you have a project that's usually more complex, more development, harder to turn around. This is typically what happens on a preferred return project that is a bigger turnaround. And so it's accrued until the end. Now, this is a little more complex, but I'm still going to break this down. So this was what I showed earlier. It's the GP share, LP share of the profits. This only gets split after the preferred return gets paid first, the closing costs, and then the loan is paid off, and then return of your original capital, right? So that's what happens in a preferred return. You could have a $2 million property that made $1 million profit, for example. Well, the $2 million has to be paid off first, right? Return investor capital, pay off the loan, and then you have other closing costs, and then preferred return. And then only after that do you do a GP-LP split. This is how most investors get to, as an LP, get to doubling their money after 5 years. Essentially, you might invest at first, 100K, then 8K each year. And then in the year that you do sell it, you have a bigger pop off from the sale than usually you get from the cash flow and the return of your original capital of the 100K, the original blue 100K, right? So that's what I'm trying to show here. That's how you get to doubling your income, is you get a mixture of income along the way in the version of preferred return. And then after that's paid off, you also get paid in the sale of the property. And the majority usually comes from the sale. So now, another thing to pay attention to: how do the syndicators get paid, right? You want those syndicators to get paid because, or have some other income source, so I don't have to depend on maybe pulling money here and there from other places. Acquisition fees are the ones that you're going to hear the most, right? It's usually 1 to 5%, depending on how good the deal is. A lot of these projects, the bigger it is, usually the lower the acquisition fee. But it really depends. Some people might say, hey, I knocked 50% off the price of this building. I want a little extra higher on acquisition fee because I can still get you a really good return even with this cost. So, you just have to be cautious though, if the acquisition fee is bigger than the amount that the syndicator themselves are investing in the project, right? So, hey, I have this deal. I'm investing 100K in it myself. However, my acquisition fee is 100K. So it's almost as if I put no money in the deal, right? Then you have to worry about your capital event fee, which is about 1 to 2%. So what that means is if the building sells or if there's a refinance, investors get their money back, right? And so that money return, that's also 1 to 2%. So it's almost like an exit fee. And once it's sold or refinanced, that's usually also the end of the preferred return and you get your money back. And so it might end up just being only a 30-70 split, no more preferred return once you get your original capital. Development fees, it's about 5 to 10% of construction costs. This will only be paid if you have a development project, typically, or a value add project that has a very large construction component to it, like a heavy value add. And then asset management fees, this is 1 to 2% of the assets invested or revenue, depending on what project you go to. It pays for the running cost of management team. What that means is if you have a VA or an assistant or other admin staff, like this is usually what the fee goes towards. It's paying their salaries basically. And then there's the, of course, GP split, or in the institutional space, it's called a promote. Basically, it's the GP split. Usually that's 30% for value add. I've seen 40% for development. But I know some people care a lot more about the promote number because that's the exciting part about the equity. But I know syndicators who take 40% and can still double your money in 3 years, right, at a much faster rate. And so that to me is why, sometimes the promote doesn't matter depending on who the actual operator is. But that's how your syndicators get paid. You want to see them kind of get paid. Otherwise, you got a question like, why are they even doing this if no one gets paid out of this, right? So now we're going to talk about a few structures. It's important to know this. It's not that important to know everything about this necessarily, but there are going to be a few things around the fund structure that
will affect whether or not you can invest in the project and your overall returns. A 506B, 506C are two types of the main two types of crowdsourcing syndication. There's also Reg A and other larger projects, but most of the time when you encounter a private syndicator, this is the type of investments that structure fund will be assigned to. And so if you are an accredited investor only, and you heard about this online, it's likely that the fund is a 506C fund. So what that means is you might have seen like someone post like, hey, I'm trying to raise money for this. If that person is raising money and you reach out to them, you have to be accredited to invest. If it's not, you got to be cautious on that because they might be breaking the rules. Then there's 506B. That's for non-accredited and accredited investors, but only if you had a prior relationship. Also, you're not allowed to advertise the deal. So 506B, you need a documented past of having interacted with whoever the sponsor is on that said project, right? So that's a difference. And then when you invest, you want to be clear, am I accredited or am I not accredited, which is $1 million net worth, not including your primary home, or $200K a year in income, 300 if you're married for the last 2 years. And then you want to ask also, is this project a fund or an individual asset? Funds can usually get better deals because the money's already there and they can move faster. You also reduce risk because you diversify more, but a lot of that money is not going to be used. You just kind of leave it up in the air, right? So that's the issue with a fund, is sometimes you're just waiting for the next deal to come along. Although right now, if you are raising a fund, capital is a lot tighter, but a lot more deals are appearing that need more cash, right? Then there's also individual assets. So there's less time spent uninvested on these. That means you're buying one property typically, or like a portfolio, like a specific property. But because you're not as diversified, there's usually a bit higher risk. And so that could end up biting you in the butt. So for example, I invested in this industrial factory one time. The deal was still good, but the tenant went bankrupt. And so if it was a fund, they could have covered the income while they waited for a new tenant to re-sign and then got the building at a higher value. But because of an individual asset, the sponsors didn't want to take the risk, decided to sell it for a short and quick profit. And then everyone still got paid, but they weren't looking to take on more risk after that. So now, sources and uses of funds. So capital expenditures, renovations, purchases, and private equity. So what do these all mean? I want to figure out where the money's coming from and where it's going to. These are just a few of the things that I care about. So capital expenditures, right? How much am I spending on big projects that I'm going to have to replace, especially if you're, for example, doing a lot of work on exteriors. That's usually CapEx that you need to spend to make the building worthwhile. In an industrial building, you might be installing doors, or in our case, we installed a bunch of fences and then swapped out some of the grass to turn it into like a soccer field. All right, so that's a big CapEx. Whereas renovations, right, that budget goes towards just updating things that already exist or fixing things that are broken. Right, so there's repairs and then there's capital expenditures. I want to figure out what's the budget for both. And then I also want to figure out, how is the purchase being done, right? Is it being purchased with private equity capital? Because then that becomes risky, because the capital stack becomes more favorable for whoever the private equity group is that might want to protect their investors first versus you as the LP in the group. And so those are all things to consider. And then, of course, once you have those funds, then it's a question of, how does the split work? If you've ever heard of the waterfall structure, it just means the waterfall gets paid at a higher split for the syndicator if they outperform, right? And then typically this means the syndicator will leverage or try to get a higher return because it'll beat out a specific number. And like, for example, after 15% IRR, that number is a 50-50 split now instead of a 30-70 split. And these are just different structures that have been put in place to maximize the incentives for everyone involved in the project. It just depends on what you're willing to give up. So, all right, timelines. Say you want to invest. you found a project, you talk to the sponsor, you say, how much time do I have to make this decision, right? Usually you want to figure out, do I still have a choice, or are you forcing my hand and I have to decide today or tomorrow? And if you have to move too quick, that's usually kind of scary, right? You want to be cautious on those deals. That's like, this is a once in a lifetime, but only lasts for 3 days, right? Another thing you want to be cautious of on the next part of it is, what is your typical closing timeline? Multifamilies are usually 2 months. You also see that about 3 or 4 months for commercial. It really depends on the asset class, but that closing time will help you figure out what time you have left to actually invest and what's the final date when money is due. Right? Then, how long is it before the project sells? Usually it's 5 to 7 years for value add, 3 years for development. It really depends on the project that you're investing in. Then you also have to be curious, when does cash flow stabilize? It depends on the scope. If you have a huge value add project, half the units are empty and you're renovating the crap out of everything, there's a good chance then that scope is going to be pretty massive, and you probably won't stabilize cash flow until you finish the renovation portion. And when do typically distributions start? It's once you get enough cash flow for a little while that you can pay out your reserves, have a bit of stability in the cash flow. And then that's usually when you want to start paying out the investors who believed in you in the project in the first place. And you as the sponsor or you as the LP want to ask that ahead of time, though, so you can project for that forward, right? Now, what are the tax benefits involved? As a passive investor, you get pretty much all the same benefits as an active investor. It's not like a REIT. If you were to buy a stock, you don't get tax depreciation write-off in a REIT, but you do if you were to invest in a private REIT, possibly. But really, it's just that in a syndication, the biggest benefit you're going to get is depreciation, right? The write-off portion. And that's usually why people love being real estate investors. You can own $1 billion of assets and pay 0 in taxes, right? So what are some of these tax benefits? Well, depreciation, like I said, it allows you to write off the value of the building as if it was a value or an asset that depreciated in value, right? So the idea is that you're using the house part of the building, not the land. And for commercial building, that is extended over 40 years that you're allowed to depreciate. So if I have $1 million building, not including the land, the building portion alone is $1 million. I divide that number by 40. And that allows me every year to write off 1/40th of the value of the house, because there's wear and tear on the building, right? So eventually it gets to a point where the scrap value is 0. Technically, it's not 0 because real estate has only gone up, but of course it can go down. But the scrap value is technically the price of the land. It would be if the building was worth nothing, but you were buying it only for the ground underneath it, right? And so that's why this was so important to have bonus depreciation in the last few years. Back in 2017, the Trump tax bill included a bonus depreciation portion, which says if you do a cost segregation study, which means you have somebody do the math and figure out how much of the portion is actually land alone, you can actually take off the entire amount of depreciation. Last year, this year, it's 80% of that. So remember, I might have $1 million building. I was allowed to write off $1 million in income and then carry that forward for I believe indefinitely. I could be wrong on that. I'll need to double check. But the idea is that any overages you have on write-offs, you can keep carrying forward into whatever indefinite period of time that you can. However, this only affects people who are investors in real estate in that asset. So you're allowed to write off just a real estate portion, not have it bleed over to, say, a W-2 job. And I'll go over that later on in terms of the rules. But this is big, right? You're able to write off all of your taxes in a year if you're a real estate professional. Like the income that I earn, doing rentals and other real estate jobs, for example, as an agent, you can actually use bonus depreciation, right? That was a big year for a lot of people to write off all that income that they made in the last 2 years. This is on top of writing off their passive income. Real estate professionals can write off now their active income. And that's the really interesting part about the bonus depreciation, because now you can write off even more than you expected. So tax break number 2, that's really important. Can I 1031 into a syndication? Yes. If you don't know what 1031 is, it means if I buy into a property that is worth more than the property that I bought or that I just sold, I don't pay any capital gains tax or depreciation return. This is helpful because whatever next project that I'm buying, that I'm 1031ing into, I can pretty much do it again and again and repeat it until I get as big as I can. Now, the problem with a 1031 is that it's easier to 1031 into a syndication, but the problem is everyone has to agree to 1031 together into the next project if you're to 1031 out. What that means is, even though you don't pay capital gains tax on this project, when you sell the project you 1031 into and you don't 1031 out, you're going to pay those taxes later on anyways at some point. All right. And so that's all that means for a 1031 syndication. There's a lot of depreciation that you owe on the back end, especially if you take bonus depreciation, you still owe a quarter of it back on the sale. So once we start talking about all these projects, these are some of the biggest things you have to consider. It's the investment structure. Like I said earlier, your underwriting, your projections, where is the money coming from and where is it going? Is there waterfalls? And then, of course, finally, the fees, right? This is the biggest part about evaluating your offerings and your structure, just summarized. And so just to wrap this up, Annie and I are trying to put and make this a popular term, is use the otaku's method. Basically, it's to help you remember the parts of investing from the last 4 classes that we already did. Can you figure out some acronym, which we thought was funny, that you can kind of use to keep track of the different parts of evaluating an asset as an LP? So the first one is the OMs, right? That's your project summary. You want some portion of that OM to explain to you what is going on in the first place, right? And so that's usually required by most people who are buying in the first place. So any sort of offering memorandum that you can get, use it, because that'll give you the first pass on what it is you need to know. Then there's the T12. So these are the actual financials. This is where you go to look up your expenses. This is part of the underwriting, right? And you want to check out, if I input these expenses into the future project, is this a realistic estimate of what my expenses should look like? Then I want to look at the asset. So what is the quality of the building and the area that the building is actually in? This is more on a property level, right? Is this a A-class, B-class neighborhood? Is the building from the 70s or 60s? Does it have galvanized plumbing and other flat roof and other issues that I don't want to deal with personally if I were to buy the property on my own, right? And then you want to look at C, which is K, comparables. It's basically, are the prices and the rents at a discount, right? That's really what matters, especially if it's value add. Where can you actually get it to? And is that achievable? Is that reasonable? If you have a 1970s building and you're like, actually, there's this comparable down the street, someone's charging 3 times the rent, I can get it there. Oh, wait, it's a brand new build, right? Those aren't really that useful. And maybe it's right next to the train station, and you don't really have that on the building that you might have. And so those are things you really want to consider when you're doing your estimates. Is the price and the rent at a discount? When I look at other market cap rates, how far off am I from a per unit price that's reasonable? Am I just, overpaying? And that's kind of what you have to think of as an LP as well. You don't really notice this until you start talking to multiple syndicators in the same market. And that's the thing, is how do you find other syndicators? Well, there's this great resource called Palace HQ that'll help you find and contact other syndicators in the space. And then finally, second to last, is underwriting. It's the U part. Are your projections conservative? So now that you have the project summary, you have the actual financials of the expenses from the T12, and you know where you can get to with your comparables, is everything else conservative in that budget? That's what we went over that underwriting class. We talked about what are your rent growth projections, what are your vacancy expectations, what are your reserves, right? These are all part of, is this project going to be safe or not on the tail end once things are finished? And then finally, sponsors and the structure. do you just trust this person, right? How much do you think they're going to gank you on the fees? And how much risk are they putting on the line to make sure this project works? So that's kind of it for the Otaku's method. We're going to try to pitch this a little more often, just get people to understand what we're talking about. But that being said, that is the end of our presentation and our time here in this class. I'm going to take questions now if anyone else has any. I'm going to start going over the Q&A here, and then we'll wrap this up today. Okay, Annie said, for the capital event, if they do refinance and sale, would that be charged twice? No. The exit fee, or, well, it depends. The capital event fee, it only gets charged on the return of your initial investment. And that can come from a refinance. So if you refinanced and you pulled your full amount of your capital out, then you wouldn't really be able to be charged on the sale, right? Whereas if you sell the building, you've already gotten all your money back, so it doesn't really make sense. And so the capital event fee is really associated with the return of your original capital. Some people might do a capital return fee and then also include an exit fee on top of that. It's not my place to say, but the refinance fee, or at least the capital event fee, is usually based on the percent pulled out that is returned to you of your original capital, right? And so you pay the full amount if it's a sale and you get all of your money back, or if it's a refi only, you might only get a portion of it, because not every refi pulls out 100% of your original investment capital, right? Edison said, I will finish having a drop. Glad I was able to join. Yes, thank you for being a part of this as well, Edison, that you were able to be part of this. Annie asks, can you explain more how funds work? So a fund is this place that you can park your money. Once people invest in this fund, you take your money and then you figure out, where do I invest this in? But the thing is, now I have a long timeline to select. Most of the time with individual assets, I'm already under contract to buy this building. We are 30 days from deploying the capital and trying to get our ROI on it. Whereas with a fund, it's the money sits here and we're waiting for a project to come along that's worthwhile. Or sometimes you might have one or two projects that are already on the horizon that are ready to be purchased. Now, the benefit of the fund, though, is I have multiple properties here. I have one property that is kind of struggling, and I'm going to use this other one to help it with cash flow until it gets to the other side. And because I have more than one asset, I am diversified, because one building might burn down, but the other ones are supporting it with cash flow while I'm trying to get my insurance payout. You also get the benefit of, because the cash is ready, you might say, that deal looks great. I don't have to spend money raising capital again through another syndication. So I'm just going to buy it with my fund and pay cash. So that's why I was able to knock off 25% from the deal, because whoever was selling it to me was very desperate to sell. And they wouldn't have done it if I hadn't already had this money lying around here, proven that I could purchase it at any moment in time. The thing is, now also savings rates are like 4 or 5%. So if you put the money into a money market, you're at least still getting 4 or 5% by investing in the syndication while waiting for the project to come along. And so that's why funds are still beneficial in some way, because you're going to park the money there anyways. You might as well just wait and invest with somebody who has a project that's coming along, so that when they announce it, everyone can jump together and buy the property together. So, okay. And he said, how do we review on their offerings? So the fund has to announce, even if it's a blind fund, they still have to announce which asset that they're buying, right? And so you can't really review it. All you can do is review based on their track record, their past projects mostly, and then what they're looking to buy next. And so that is really the big thing with these offerings for funds. It's hard when you don't have a future project that you can estimate already. All you can go on is how have they done in the past, and in investing in those. Okay, what is the difference between a regular fund and a rescue distress fund? A regular fund, there's not really a difference. It's just like, what is the target for the purchase? Most of the time when people say funds, hey, we're looking to buy a standard apartment complex building, for example, and fit it into our portfolio of other apartment complex buildings. Whereas a rescue distress fund is, hey, I want to buy specifically assets that are failing, that are at risk. and I'm going to pay dirt cheap for them. That could come in on the equity side, or there's two other ways right now to invest in failing projects. One is preferred equity, which is what I was saying is you are coming in at a superior level to the existing LPs. And then whoever is the sponsor of the project is going to get kicked out if they don't pay the preferred equity back in time at their 14, 15% interest rate. So the new sponsor will come in, take it over as the GP spot, and then their LPs in the deal get first priority to get paid out. And so whoever's coming in preferred equity might take over a property for a fraction of the price, right? Whereas with with equity, you're still taking out some of the risk, buying it yourself, doing the value add, turning it over. Then you also have to worry about, on top of that preferred equity portion, you can also transact a distressed asset fund in the form of a mezzanine loan. So what that means is you're adding a second position loan on a project, and then ideally you're also asking for a personal guarantee on top of that. So say you have a $10 million building and they need cash right now. So what you say is mezzanine loan, I'll give you $1 million. The building is maybe worth 12 million. So you're like, okay, if it falls more, there's $11 million in this project all in, but it's only worth 12 million. It might fall more in the future. So I'm going to ask for a personal guarantee from the sponsor that says like, hey, you're worth another 5 million. You can use your assets as security. So I'll get you to the other side with my cash, but I don't want to deal with risking my own money to go below a certain number. I'm just going to take yours and everything else you owned just to help you stay afloat on this one project. And that's what the mezzanine loans are for. So those are the three ways that a distressed fund can really take advantage right now of the market: a preferred equity, mezzanine loan, or mezzanine preferred personal guarantee loan, or coming in as preferred equity. Lay asks, what's a typical time period to return the capital? Depends on when the project says they were going to return the project money. It can be at the sale. So for value add project, that'll be 5 years. Right now we're doing return of capital on our refinances. So it's only been like 2-ish years, right? And how do you set up the company structure for the syndication or fund? Well, it costs about 10 to 15K for the syndication portion. If you want to do a fund, that's usually more complex. That's usually around 25 to 50K, depending on how many tiers and the complexity of the project. But if you're curious, happy to introduce you to my lawyer. If you need that connect, I've been working with him for years now, and this is probably, I've done a half dozen projects with them at this point. So, happy to give that introduction. And he said, when we look at an OM, how do we know what funds are from private equity or has a mezzanine loan? Usually it's stated how much is put into it. A lot of times people will use a mezzanine loan on the acquisition and then buy themselves out once the project gets under contract. So it really depends. But if there's also private equity, like a stack, whoever is the sponsor should say that, but it's also usually included in the operating agreement. So once you read through it and you say like, hey, why is this Class A shares have this stipulation that if they don't get paid, you guys get booted and then we get second position? It's like, well, so that's kind of like a red flag. Basically, not all Class A shares are red flags. It's just like, what happens if the Class A doesn't get paid? That's really what it is, right? So if you have a straight 10% Class A preferred return, it's like, well, what happens if that doesn't get paid out? In like, is that like a private equity project or or preferred equity project, or is that just like, a Class A raise that that might not be paid out? It really depends on how it's structured. This one I have a harder time knowing, other than just because you really figure out by reading the operating agreement. Once you read the operating agreement, it'll usually explain that. And so that's kind of why it's important to look over those documents. I recommend getting a lawyer the first 1 or 2 times to help you keep track of these things. And then once you understand it a bit yourself, you should probably be able to read it later on in the future. For 506B or 506C deals, would you say one is safer than another to invest to? Not necessarily. It really depends. 506B deals have unaccredited investors, but some people prefer this because they want to offer these products to their family or friends who might not be accredited. And so 506B is typically easier to raise capital, especially on some smaller projects, but I also know huge funds that do 506B only. Right. So it kind of depends on what your sponsor is looking for. 506C deals, on the other hand, can also get a bit obnoxious because a lot of people, by default, 506C would be safer because it's all credit investors. Possibly, not necessarily. It depends on who you're investing with, right? So if you have a 506D deal, for example, that you invested with through Grant Cardone, who only does 506C, but is not known for being the best returns as an investor. Well, he's doing 506C because he already has this reach, and that's how he gets people to invest with him, is through 506C. Otherwise, it'd be really hard for him to do 506B because he might not have met everyone that wants to give him money. But typically 506C is done for bigger projects. That's correct. But not always the biggest projects are 506C. Reg A is actually larger, and then there's also these mini IPOs. So regulation, crowdfunding, and all these other terms are a bit more complex, but the Reg D exemption actually has no limit on how much money can be raised. But there are certain deals, like a Reg A deal, that would allow investors to both be non-accredited, but also be advertised to at the same time, right? So it depends on what you're doing, but that's, for example, how Lambda does it and Concrete does it, I believe, right? They have Reg A deals. And so 506B, 506C, they each have their own set of rules and regulations. But there's also other funds and assets that don't have those regulations. Reg A starts at like 50 to 100K to file, right? And so it really depends on the project that you're going after. And everything, the more access you have to individuals, the higher those legal fees are going to cost when you're trying to raise. So. Okay. All right. And if that's all the questions we have for tonight, I'm glad everyone else was able to make it. I'm going to call it night. Thank you all for being here with us. And we're going to upload this to YouTube. We're glad you're able to join the series. And we're going to send this out later on to everyone who registered in terms of all the recordings. This wouldn't have been possible, of course, without Perry and Palace and Cashflow Portal helping us out and pushing us towards this to get everyone as educated as they can towards investing in these syndication projects. If you have any further questions, feel free to reach out to me or Annie. All right. Thanks, y'all. Have a good rest of your night.